Okay.
I see people still coming in. Maybe we wait one to 2 minutes.
Yeah, I'll leave it to you, Joyce.
Yeah, I think it's time to get started. Okay. Welcome everyone, and thanks for joining today's faculty front row session. My name is Joyce, and I'm the incoming co-president of the Impact Investing Club. So the club is a platform for practical application of impact investing and a vibrant community to develop network and friendship. So in today's session, we will explore impact investing. So how to use capital to make a difference? What is mean in practice to incorporate non-traditional criteria in the investment process? How do such activities affect risk and return? The session will be led by Professor Vikram Gandhi. Professor Gandhi developed and now teaches HBS first impact investing course, Investing in the 21st Century, Risk, Return, and Impact. Outside his work as a professor, he founded Asha Impact, an impact investing platform for socially conscious individuals to leverage combined capital, networks, and expertise to address critical development challenges facing emerging economies. He's also a senior advisor to the Canada Pension Plan Investment Board. Thanks again for joining. Now I will hand it over to Professor Gandhi.
Thank you so much, Joyce. Thank you for that kind introduction, and good evening to everyone. Welcome to the HBS front row session. I'm actually delighted that we can take an hour here so I could talk a little bit about some of the work we've been doing at HBS on investing for impact and take you through some of our kind of thought processes right now. I'm also delighted that two of my friends and protagonists actually of cases that we have and teach at HBS are joining us today. The first is Chris Ailman, who is the Chief Investment Officer of CalSTRS, which is the largest a pension plan focused on teachers, over $200 billion. And Chris has been kind enough, it's actually his week off. And so rather than in his virtual office, Chris is helping his son-in-law do some work at a university. And so he's at a university campus joining us there. So thank you for being with us, Chris.
My pleasure.
Our other guest is Hiro Mizuno from the GPIF for the pension plan in Japan. Which is a $1.7 trillion pension plan. Hiro was the chief investment officer, left that role at the end of March, and now is doing a variety of interesting things. I think he's not with us yet. But
I'm here.
Oh, you're there. Okay, great. Yeah. So Hiro's here as well. So welcome, Hiro. And Hiro will be joining the HBS faculty as HBS fellow.
Sure. I can definitely see that, yes.
Will be joining as an HBS fellow and on a variety of different topics has been a leader along with Chris and others on really integrating impact into the whole investment process. So the way the session is going to work is one is I'm just, because I'm not sure what the level of knowledge is of the group here, is going to just lay the framework for about 10-15 minutes as to what is ESG, what is impact investing, and how does it actually fit in with modern investment processes, and then go into a bunch of case studies with Chris and with Hiro and discuss with them the kind of what's happening in the world today in the context of their cases, but also just more broadly, particularly given COVID, given a lot of these issues around income and racial inequality. What does that mean from an investor perspective? We'll then have about 20-25 minutes of a Q&A session, which I would request that you use the hand function, which I guess there are MBAs on the call, but they're also alumni. So there at the bottom, you'll see there is a hand function when which you can raise your hand and I'll call on you. And then I'll do a 10-minute wrap at the end of the session. So just to get going on this, and I would really appreciate if you could all put your, keep your videos on or off, but more importantly, if you could put yourselves on mute, that would be fantastic. Getting to the topic of the discussion today, investing in the 21st century, risk, return, and impact. And I'd like to set the stage here by basically saying that, people have been investing for centuries, but till about 100 years ago, most people, when they invested, they were looking at the return criteria. And then that was kind of the main criteria. And then they realized over time that 2 or 3 investments with the same kind of return, but with very different risk profiles, actually are not the same. And so therefore, over the last 50, 75 years, there's been a vast body of knowledge developed around risk assessment. How do you bring in risk into the investment equation along with the return? And therefore, the concept of risk-adjusted returns comes about. And there's still a lot of debate as to how you do that, et cetera, but that's now kind of entrenched, if you will, as the way investment works. And what we've seen in the last 10 years or so is this growing third dimension of investing called impact, which is how you bring in impact into the investment process from a variety of perspectives. One is incorporating the risk management. Is there a way to bring impact to have better investment decisions? And equally importantly, is the role of investors beyond pure financial return, not to sacrifice financial return, but beyond pure financial return, to have a broader impact on the important societal issues that we're grappling with, such as climate, such as racial inequality, such as income inequality. So that's the broad thesis here and the broad framework. So if I just go through a couple of slides here, the first is what is essentially the point of when we talk about definition of impact. And there are various definitions, but just to set the stage for the purpose of this discussion. So first of all, impact investments are investments. This is very important, where there's an intention to generate a positive, measurable social and environmental impact in addition to financial return. So it's really the intention piece and the investment piece that is very important here, that it's an investment, there's an intent, and therefore you're bringing those two together to generate both a societal return and a financial return. The other concept, and this is, it's predominantly in the private markets, but it's becoming more and more prevalent also looking at the public markets. We then have what is ESG. And so ESG essentially is environmental, social, and governance-based investing. And we'll get into that in a little bit. Where are we today when we talk about risk, return, and impact? Where are we today in terms of the investment process and how many assets in the world are actually subject to some sort of a ESG impact overlay? So that number today is 30 trillion. In fact, this is about 6 months ago or from the middle of 2019. So I guess it's higher than that right now because the rate of growth has been enormous. And that equates to about 25% of all professionally managed assets. So this is just to put it in context, 30 trillion, the US stock market is 30 trillion. And so this is about 25% and the percentages are going up. So then the question is like, why is this happening? Why is this happening more recently? Why didn't this happen 20, 30 years ago? And I think there are a couple of 2 or 3 key drivers of it. One is that you certainly had kind of a generational shift as to what's important, both from a consumption standpoint and an investment standpoint. And there have been a bunch of research studies done this, but one of them is here, which is we interviewed a bunch of people in different age groups, baby boomers being 55 and over generally. So 25% of them said they had some interest in impact investing, they felt it was important. 31% of Gen X, which is essentially between the ages of say 40 to 55, said 31%. And then the millennials is 57%. And so you're seeing that the younger folks are getting more and more focused, not just on making money or consuming, but having an impact overlay on that. And why is this important? Because over the next multiple decades, really $40 trillion of wealth will be transferring from the left side of the space, the baby boomers, to the millennials and then Gen Z. And so therefore, you're going to see a big shift in terms of how people view their investment portfolios and how they operate on them. The other piece is that the world is facing some enormous challenges. If you use the UN Sustainable Goals as one kind of framework, and it's kind of become more like the North Star now, and say that, well, what does it actually take to achieve these goals, and climate and gender and income and race are part of this. The best estimate is that this is going to take about $5 to $7 trillion per year of investment. And there's absolutely no way that public and philanthropic capital is sufficient. In fact, the IMF and the World Bank have suggested that essentially there'll be $3 to $3.5 trillion of a deficit based on whatever they've seen, and that we'd have to kind of co-opt private capital to solve these problems. And keep in mind, private capital with fiduciary obligations cannot sacrifice returns. So bringing those two things together and making it happen has become really a critical imperative of our times. I happened to be at Davos, the World Economic Forum in January, and it was interesting to see that of the 150 business sessions over 3 days, approximately 2/3. Now this is, there was some COVID talk about at Davos, but it was this something is happening in China kind of thing, as opposed to anything broader than that. But approximately 2/3 of the sessions there were dedicated to climate, broader ESG issues, and shareholder focus. And what the role of investors is in that: accelerating climate transition, investing in carbon capture innovation, adopting metrics so that you can actually evaluate, compare, and more importantly, measure performance and measure progress. And then the whole broader concept, which we'll touch on towards the end of this discussion, is accepting stakeholder capitalism as a concept beyond the shareholder capitalism that's kind of existed for a reasonable period of time. So what does all this mean? I mean, what is the opportunity here? So if you think about that, so that's the backdrop. That's why this has become important, et cetera. And the question really is like, what is the actual opportunity here? So if you have a chart here, which basically says that on the vertical axis here, let's say you could have $1 and get a financial return. And on the horizontal axis, you have social returns. And you could basically say that, look, for every time I want to increase my social return, I got to decrease my financial return, and therefore there's a direct kind of trade-off. And the key opportunity for us here is for how to get that $2 to $3 trillion of private capital to solve important societal issues is, can we bend the curve? Can we actually make this happen, which is, let's not sacrifice financial return, but achieve social return at the same time. So with that, I'd like to stop for a second and perhaps do a poll. Emma, maybe you could, let me put this poll out, which is, do you believe investors can have impact without sacrificing financial return? Okay, so we've got roughly, essentially, it's about an 80-20 split. 80% of the folks think that we can have, we do not need to sacrifice financial return for social return, and there are 20%, and in fact, this debate is continuing. I would say that there's more and more evidence that we've more and more evidence, but we need to collect more evidence, which would suggest that this trade-off is not necessarily there. So if I go back to the chart that we were looking at before, which is the can we bend the curve? We have, as a result, Sean Cole, a colleague of mine, who I think is on this call as well. Basically, he and I, over the last 3 years, who strongly believe in this topic, have developed a new course at HBS. I know there are MBAs on the line here, but there are also a lot of alumni. So just to kind of get the alumni up to speed as to what we're actually doing on campus. So we've developed, it's an elective class. Basically, all these cases have been written in the last 3 years. CalSTRS cases there, but we talk about what's going on in the private markets, how do you measure and manage impact, what's going on in the public markets, and where are we going from here? If we break down assets into asset classes, and we're looking more at equities here, but this is as important for fixed income as well. Essentially, you've got the private markets and you've got the public markets. And in the private markets, the key issue is it gets back to the definition, the private markets being venture capital, private equity, et cetera. The key issue being the intent to generate impact. I mean, you could always make the argument that any new business you start, anything you invest in, you're creating jobs, et cetera, so there's impact. But this is actually more that there's an intentional focus. The other thing about private markets is that, especially if you're talking about the category where you do not sacrifice financial return, that there's the returns continuum, but you can in one bucket, and I'll get to that in a second. So we just, as an example, we have two cases which we teach in that module: financial inclusion at Omidyar Network, the Rice Fund, which was the first time a major institutional private equity launched a fund, private equity firm TPG launched a fund. It was about $2 billion, and they're now on to their second fund. But since our guests today are very much focused on large pools of capital and big players in the public markets, I'm not going to spend a lot of time in the private markets and really spend a lot more time on the public market side. So on the private side, just to finish that, we have just one kind of framework on the private side, which is what we call the returns continuum, which the Omidyar Network, which was Pierre Omidyar, who was the founder of eBay, sold eBay, and then has developed and been one of the leaders in the whole impact investing framework and thought process, is that on the left of this, you have pure commercial returns with impact, i.e. you're not sacrificing financial returns. And there, the model of business really is collinear. So every time you make money, you have impact and so forth. On the right side is charity, which is essentially you're giving capital away, you're not expecting it back, but you've got massive social return. And then there's a category in the middle is that you consciously sacrifice financial return for social gain. And so there's the whole continuum here. And in our course, we talk about a lot of different situations and how people are approaching these different areas. But getting the A's and B's categories and getting private capital into those is, again, a key issue of impact investing, a key objective in terms of advancing, say, the UN Sustainable Goals, et cetera. I'm not going to spend more time on private markets, as I said, so let me move on to the public markets. So in the public markets, by definition, because you're owning a much smaller percentage of the company typically compared to the private markets, the level of influence one particular shareholder can have is somewhat limited. So if I own, in private equity, I own 80% or 100% of the company, I can influence outcomes a lot more. In the public markets, even large institutional investors like GPIF or CalSTRS will probably own a small percentage of the company. So how do you actually influence, or how do you actually have impact in the public market construct? So there are four approaches. One is negative screening, which is you essentially just don't buy things. I mean, I say I will not buy alcohol stocks or tobacco stocks or gun stocks. We're going to talk about that today. So you screen out stocks. The other is positive screening. I will invest in companies that have better and more sophisticated gender diversity kind of objectives and have actually proven that that's happening, for example. The third is ESG integration. There is more and more a body of knowledge which suggests that integrating ESG into your financial analysis results in better investments because you're factoring a long-term risk in a much more thoughtful manner. And the fourth is that as a shareholder, even though you're a small percentage, through the process of engagement with managements, through the process of the proxy voting seasons, proxy voting, can you engage with managements to actually alter behavior and create value over a period of time? So that's the public markets. I want to stop here for a second and show you a video, and then we're going to get the discussion with Chris and Hiro going. Show you a video. This is from last year's Harvard commencement. And obviously, it was very disappointing that we couldn't have another one this year in person. But last year, Al Gore was the class speaker at Harvard College's commencement. And this is a short 2-minute kind of excerpt from his speech.
Fossil fuels can no longer compete. The largest sovereign wealth fund in the world in Norway, financed completely by oil and gas revenues, has started divesting from fossil fuels, and so should Harvard University. That is one of the remaining challenges for this university. I want to make it clear, this is a moral issue. It was immoral to continue investing in apartheid. In the 1980s, when I was in the United States Senate, the student activists of that day at Harvard recruited me to run as one of their candidates, as a candidate for the Board of Overseers, in order to help push the university past its resistance to divest of apartheid stocks and stop supporting that racist system in South Africa. Now, fortunately, The student activists recruited someone else to run with me on that ticket, Archbishop Desmond Tutu, so I did not have to do much heavy lifting. But the university did respond. As they responded, when they realized it was immoral to invest in tobacco stocks. Well, let me tell you, the oil companies and the gas and coal companies today have been following the same strategy innovated by the tobacco companies years ago when they decided to undermine the authority of knowledge. They wrote in a famous phrase, and I quote from the tobacco industry documents, "Doubt is our product since it is the best means of competing with the body of fact that exists in the mind of the general public." The fossil fuel companies adopted the same playbook, the same strategy, hired many of the same PR strategists and technicians.
Okay, so maybe we're going to stop. We're going to have another quick poll here. Emma, if you could get us on that poll. So the question really is, do you agree with Al Gore? Should the Harvard Endowment divest all fossil fuel investments? And just so you know that they did make an announcement, the endowment did that they're going to go greenhouse gas emission free by 2050, but that does not really involve selling fossil fuel investments. Yeah, so roughly, this topic always involves, and we could have a full class and debate just on this particular topic. So we've got about 60% who say yes, we should divest, and 40% no. And that's based on my experience of having these discussions over the last year or so, is pretty similar to other polls on this topic. So with that, let me basically ask Chris. So, basically we had a case, Chris, which we've written on gun control. How CalSTRS was very, very focused on gun control, and essentially this debate of divesting gun stocks versus engaging. So how do you think, do you think Harvard should divest of fossil fuel stocks? And how is CalSTRS approaching this topic?
Thank you, Vikram. Thank you for the chance to participate in this front row. The first thing I would say is the Harvard Endowment is not supposed to invest on moral grounds. And the question is, how do you define moral grounds? CalSTRS is a trust fund for public school teachers for their retirement. Our stakeholders are public school teachers, but they're also the taxpayers across the entire state of California. So it's very difficult, and our fiduciary standard does not ask us to make moral judgments. The other thing is when we made that decision on firearms, even though people have judged that as a moral or a political decision, it was a very specific divestment of products that were against the law for sale in the state of California. So our divestment was really on specific items that weren't legal in California and we didn't believe we should participate in investing in. And I would point out, Al Gore, I appreciate what he said. I have heard him make that statement many times. Isolating South Africa in the late 1980s, early 90s is completely different than trying to isolate or objectify the tobacco industry or the fossil fuel industry. So we have divested of many items. I can say with strong conviction, it has not impacted the companies in any way, and it hasn't made any social changes. So I think it's time to really divorce the focus on divestment and boycotting with trying to bring about social change. I think it's ineffective in the 2010s, 2020s.
So when you talk about, before I bring Hiro in, so when you talk about social change, so let's take gun control. I mean, the case was essentially, you basically advancing the cause of gun control, but it was more about coming up with principles. So how does a big pool of capital like CalSTRS bring about social change? Or more importantly, why should you? As you said, it's a fiduciary obligation, so why should you bother?
Exactly. There are many times I have argued with our board that I'm an investment, and I run an investment team. I'm an investment officer. If you want me to bring about social change, I need a different staff and I need different tools. And social change is not, capital is an ineffective tool unless you can isolate something. And there's too much capital in the world today. Back in 1987, we were the 3rd largest pension plan in the USA and probably the 5th largest in the world. Fast forward to today, we're the 2nd largest pension plan in the USA. We're barely in the top 25 in the world. There are other huge pools of capital, and capital is way too plentiful to isolate. Most of the major oil companies in the world are actually privately held by individual countries, and they are not going to be affected by whether we invest or divest of their stock.
So Hiro, let me start, as Chris mentioned, that the largest pools of capital, so you were the chief investment officer of the largest pool of capital in the world, the $1.6 trillion GPIF. And by the way, again, thank you for being with us. It's 6:30 in the morning Tokyo time, so we really appreciate it. So how do you think about this concept of engagement? I mean, when you were CIO, were very, very proactive on a variety of issues in ESG, but let's say focus on climate for a second. How do you think about GPIF and climate?
Well, thank you, Vikram. And this is my first, the participation in Harvard Business School program since I was invited as an executive fellow. So I'm really glad to be on your event as a first.
And in fact, you and I were the last folks that had an online discussion in Klarman on March 4th before the whole university shut down.
Oh, absolutely. Yeah, absolutely. Yeah, that's right. So, well, I mean, Chris raised several, the interesting discussion points. As I was a fiduciary, I was a fiduciary investment chief of the Japanese public pension scheme. So the basically every single Japanese on the street was my beneficiaries, right, and the contributors as well. So. The fiduciary debate always, create a lot of challenges as, we kind of imported the concept of fiduciary duty. I started, originally started in the UK and then, they kind of expanded that concept in the US and Japan imported it. So the concept of the fiduciary duty is something like only, focus on the financial return, and talking about morale and the value of my own is actually prevent me from fulfilling that responsibility. And I really struggle with it because first of all, I grew up believing that we cannot make financial or the business decision without having the values or having the sort of moral, the consciousness. So I never, to be honest, grew up just having the believing in the personal value or moral judgment and the business success are mutually exclusive. So I always have a have a belief in that those have to be delivered both at the same time. So. That's the first thing I always wanted to, first of all, raise it. And everybody has to work in a different constituency or different work, the environment, but everybody should think about it, whether it's like a black or white or mutually exclusive, the factors when you talk about it. So I really been challenging that concept of, leaving your morale behind because your job is to make money. I think we need to bring the morale to make the money. So that's one thing I wanted to raise. And second point is I have been advocating all the investor has different way to most effectively contribute to better the world and also the better the portfolio performance. So I actually was the biggest negative advocate for the divestment because the GPIF was under huge pressure from NGO and some other investors like Norway, which Al Gore mentioned. GPIF should divest from the fossil fuel, but my argument was divestment for us, meaning we are just giving the ownership of the company, which we think problematic, to the people who don't care about it. Right? Because when we divest, somebody will buy it at the lower price and make a better financial return. So that we are actually benefiting the people who don't care about these issues. And if I were CEO of those companies, I would be happy to hear GPIF is divesting, probably, because as Chris they pointed out, now capital is not that precious. In today's capital market, we have the affluence of the capital, and now all the monetary policy, cash is we have too much cash in the system. So taking the cash away from the company in the stock trade doesn't make much difference in the way they operate. So I think the most effective is stay in the game and engage with the executive to change their policy. That's actually probably more effective.
So yeah, so let's talk about that engagement piece, right? Because that's something which, again, I was seeing some data recently that, the proxy season that's been come up last year, that more than 50% of ESG oriented policies went through. But I do want to kind of focus on the fact that this is not about necessarily being the do-good kind of thing. This is about, as long-term investors, or both of you are kind of basically, given your asset liability mix, are long-term investors by definition, isn't it your responsibility as a fiduciary to protect long-term value? And to protect long-term value, you need to engage with companies to make sure that value is being protected. How do you think about, particularly on the concept of climate, right? I mean, climate transition.
Sure.
Chris, maybe you could start with you and then get Hiro's comments on that.
Well, Vikram, I think I hit it on the head. When you look at that graph you created, the vertical axis of financial return, I'm on that dead center. That's what my goal is. But I want to do that over 30 or 40 years. So I want companies to care about their brand. I want them to be more sustainable. And climate change is a real legitimate threat right in front of us. If Al Gore could solve climate change by divestment, I would be all in favor of it. But the reality is, Harvard and other people divested in South Africa 5 years before there finally was some change. There were a lot of other global events that took place. And obviously they're hoping that this will start again by starting it with a divestment campaign. I just don't think that's logical. People are still going to drive. In fact, the protesters that come to my meeting drive to the meeting using fossil fuels. So for us, it's about engagement. It's about getting companies and CEOs to stop thinking about 91-day time periods. There's far too much short-term thinking in particularly U.S. companies, and to think about what that company is going to be like in 20 years or 30 years. Because we're such large, long-term passive investors, we're going to own their stock longer than their CEO. So for us, it's really trying to get them to think about, how is this product, how is this company going to operate 10, 20, 30 years from now? And so our main discussion right now, Vikram, is adaptability. How are you going to adapt to this changing environment, changing world, and stay ahead of the curve instead of being behind it?
Right. So, you've got an active portfolio and a passive portfolio. Hiro, a lot of your investments were through what I would call a passive portfolio, investing in ETFs and through, the three big players, which are BlackRock, Vanguard, and State Street. So talk to me about how a passive portfolio and the percentage of assets under management that are passive is increasing. How can a passive investor actually influence corporate outcomes?
Sure. I think we had to kind of broaden the sort of definition of passive management. Because when I came into the CIO role, and when I started discussion with the Vanguard, all the BlackRock and the State Street, the big passive guys, they basically had the concept of the passive management is just a following and tracking index and at the lowest cost. So in other words, the best passive manager delivers lowest tracking error to the benchmark at the lowest cost. And we challenged it because passive management means passively managing the portfolio, but it doesn't mean they have to be a passive owner. So we basically ask the passive manager to become active owner, meaning they proactively engage with the company in their portfolio, to guide the portfolio company into the more sustainable direction. And that's something, the sometime in active management, because, I totally agree with you, Chris, because active managers tend to have a much shorter investment time frame because their performance evaluated that way. And sometimes these engagements on the long-term sustainability of the business have some conflict with the short-term performance for the benefit of long-term sustainability, right? So the active managers always have that struggle, but the passive manager, they don't need to be responsible for the quarterly performance as far as it track the index, right? So I think the passive manager is the one who can be more aggressive on the engagement with the corporate executive. Right. And then I failed to respond to one of your earlier question, which is why the GPIF regarding the climate risk is a big, the big issue, and we spend a lot of effort on that one. Is when I ask the all major investors, do you think the climate risk is actually is a risk for your investment? 99% of people says, yeah, it's a risk. And then when I asked the follow-up question, which is, how do you integrate that risk into your portfolio? Or do you think the current stock market already integrated that, already priced that risk in? Everybody says not yet. So that means the risk is existing and we are aware of it, but we didn't have any action to reduce it. So we just concluded GPA has to do everything to reduce the systemic climate risk, because everybody says this is a risk for a portfolio for the long term, and nobody's taking care of it. So unfortunately, what the finance faculty taught me how to reduce the risk of the portfolio didn't include how to reduce the risk of that kind of like a long-term systemic risk.
No, that's what we are doing at HBS now. We're kind of getting that's why we're getting you as HBS fellow.
Yeah, that's right.
To help us think through all that. So absolutely. I'm going to ask one question and then I'm going to open up to the audience. So maybe Chris, if you could talk a little bit about what's been going on in the US in the last, there's a broader global COVID issue, but then there's also the issues of income and racial inequality. And what that's brought out essentially is that there's been a lot of discussion on E, the environment piece. And obviously climate issues are not going away. They're going to be, in fact, even more front and center going forward. We've talked about G, but the S piece kind of somehow is there, but no one focuses on it enough. And that this may bring that to the forefront. As an investor, how are you thinking about that topic?
Yeah, Vikram, of E, S, and G, we have been at S actually the longest. CalSTRS had a social policy all the way back in the 1970s. But what I have found personally is that it's very sporadic and it tends to be very eye of the beholder. Right now, absolutely, it's a question about diversity, Black Lives Matter, about income inequality, but it's also been about health issues. In the past, it was about AIDS drugs. Before that, it was about tobacco, and then all the way back to the 80s when it was about South Africa and civil rights. So E, S, and G matter. They matter equally. We've been at governance for over 30 years now at CalSTRS and still fighting for better governance. But it's really the E issue that is in front of us and is tradable. It is a significant event that's going to occur in our careers, and people have to really pay attention to that as a risk in their portfolio. So the hard thing has been, as you put, integrating it. There's exclusion investments, which we've done and have not been effective. We lost money in virtually all of our exclusions. There's the idea of positive attribution. And really it's about integrating ESG into your investment analysis. If I said to the participants on this call, I think you should integrate long-term business risks into your financial analysis, everybody would say absolutely.
Right.
It's defining those long-term business risks that's part of the challenge. We use the letters E, S, and G, but that's what drives us and drives our risk analysis and is a big focus for us.
Yeah. And I think as both you and Hiro have said, what we found also is that while companies and investors talk about it, actually integrating that into the financial analysis and what that actually means and what the implications for value are is very hard to actually do. I mean, there's some folks that are doing it well, others not so well, but it's getting front and center focus. Let me then. Yes, please, Chris.
I was just going to add, sorry to interrupt. I have finally, I really realized that with CEOs, when you talk about their brand and protecting their brand for 10, 20, or 30 years, that's what gets their attention. And actually, that's what brings about social change. It's that social media impact that we've seen most recently when companies have reacted very quickly to the Black Lives Matter issues and the racial inequality. It's the realization that they care about their brand and they care about how public perceives it. As shareholders, we do too, because that's corporate value.
Yeah. All right, let's take a few questions from the audience. Just raise your hand if you'd like to ask a question. If not, I have lots. I think this is a big group, so I think people are a little hesitant. So let me come back. So then, Chris, in terms of as you think about the governance structures and you think about global markets, are you seeing, and Hiro for you too, on a relative basis, where is there more traction in terms of integrating ESG into the investment process? Because I know, when we look about what I say about the 30 trillion, there's a much higher percentage of assets in Europe particularly, that have some sort of an ESG overlay. So if I look at both the US and elsewhere, what needs to actually happen to kind of move the needle on these important things?
Well, from my perspective, Vikram, investors need measurable, consistent data so that they can analyze it and look at these trends. In terms of the adoption, no question, it's more outside the United States. Principally, I would say Europe, then Australia. Hiro really made a big push and really changed the focus in Japan and in Canada. In the United States, not surprising, it's up the West Coast, a little bit across the northern states, and then down the eastern seaboard a bit. The middle of our country doesn't really focus on ESG and doesn't really seem to want to care. It's sadly very divided between red and blue states in terms of the adoption of ESG and the analysis. But I would say that the more we have stronger storms and that hit different areas, they are now paying much more attention to climate change and realizing these things are factors and they do have to think about them. But we need consistent data that we can use. We need TCFD reporting of companies so that we can make a decision and active managers can make a decision whether a company is likely to succeed or whether it's likely to fall behind.
So, but on the data piece, before you come in, Hiro, on the data piece, I hear conflicting views. Like one is that, well, the regulators should put in, the requirement, just like they have financial reporting requirement. The other is, no, this should be voluntary. It should come from investors. Investors should push for it. Which camp are you in?
I'm on the camp where right now it's got to be voluntary. Pushing this through the SEC and through, really frankly, corporate general counsels are going to fight this tooth and nail. The Business Roundtable has already started to fight it. It's just too hard of a battle. Companies that are thinking ahead are actually already adopting this and jumping on it. Companies get a lot of surveys from us. It's actually survey fatigue. And so what we're trying to do is get them to focus in on GRI, the Global Reporting Initiative out of Europe, a TCFD, Task Force for Climate Change Disclosure, and then the SASB metrics, Sustainability Accounting Standards Board, because they're industry specific. That data can be loaded on a Bloomberg screen, loaded in a Moody's report, whatever you want, and then investors can make decisions. So if we can get consistent reporting data at the company level, yes, it would be nice to be a required disclosure because then it's a blanket for everyone and it would be audited. But we're still a long way from that, and that battle just simply is not worth taking on right now.
Right.
So I go 100% voluntary, and companies that are CEOs that are thinking ahead are openly adopting this.
Yeah, Hiro.
Yeah,
go ahead.
Yeah, on ESG, I think the game is already changed, and I actually keep telling the people who are skeptical about ESG, if they still believe in what they learn in the business school, in a finance course, stock market has the characteristic of like a beauty contest, meaning, everybody's saying like the ESG is important, and now it's already exceeded the super majority who cares about it. So it's too late to debate whether ESG is relevant or not. And I still, see the problem, like, some investors, even after once they believed in that, they don't have enough data to take that into their actual financial analysis. But I was in Davos together with Vikram, and it is obvious, like everybody's now talking about the ESG and the stakeholder capitalism. It's very difficult from the investor's perspective to go against it. And even the American asset managers, all the top asset managers. One of them actually called me as a religious leader 4 years ago when I was talking about advocating ESG. Now he sounds like it has me in their founding charter. So I think the game has changed. So I don't worry too much about whether ESG will become a mainstream or not. It's just a matter of even if they believe in it, they struggle how to use it because of the lack of the standardized information as Chris mentioned.
So I think believing in it is an interesting thing, right? So we've talked a little bit about risk management, et cetera, but there's also growing evidence. In fact, our colleague George Seraphim and others have done this analysis of, looked at companies over 30 years and looked at, so for example, ESG, there's 700 or whatever ESG metrics out there. That's not important for every company, right? So each company could focus on the 5 or 10 ESG metrics using SASB or other things and say, this is what I'm going to focus on. And in fact, what the analysis suggests is looking at industries and sub-industries over 30 years, that companies that focus on material ESG things that matter to their business, things that matter for the energy businesses are different than consumer products, than tech, et cetera. Is that those folks that focus on things that matter to their business outperform. It sounds such an obvious statement that you focus on things that matter to your business, you outperform. But it just doesn't still seem to be happening. But there is an alpha opportunity there, isn't there? Lots of alpha opportunity.
Absolutely. I mean, I serve on the Future Finance Advisory Council of the CFA Institute. And when we discuss it, I agree with the CEO of the institute. It's almost like a suicidal statement. The active manager says, because we don't have enough data, we cannot, use it. Because this is a real alpha generating opportunity. Because if everybody has the same information, and if you believe in the other, perfectly efficient market, there's no alpha opportunities, right? This is a real alpha opportunities for the active manager. They should jump on it. And then for the other disclosure bit, I actually on the camp for the voluntary disclosure, because first of all, the ESG disclosure still not perfect. I mean, even if the company want to disclose it, they struggle. Particularly something like a TCFD recommendation, which requires supply chain or product cycle carbon disclosure. It's not easy. So if it is become a regulatory disclosure requirement, there's no room for them to make a misrepresentation or mistake. So I think at the moment it's probably easier for them for us to keep it voluntary, so that the company can try and that they can take sort of risk of making a misrepresentation. And one thing I would like to say is Japan was very successful because the 2 years ago, we had only 20 supporters for TCFD recommendation. We have now 260. We have the largest number of TCFD supporters. And key for that success it was not only the financial investors who pushed it, but the top of supply chain, OEMs, Toyota, Hitachi, and Sony, all those guys sign up to the TCFD. And then they urge their suppliers to do the same, because for them to make the product cycle disclosure, they need to have all suppliers to make the same disclosure, right? So I think the investor can do a lot and we can make an impact, but also at the same time, we need to pay attention to how the supply chain works. And I think that's one of the things that investors have to pay more attention to if they wanted to change the whole system.
Yeah. One last question, and then I just want to do a quick wrap here. There's been evidence, like another case that we have is generation investment management. I'm generating consistent alpha. I just want to get to the alpha piece of it, because there is, as I said, there's quite a bit of evidence that if done correctly, this is a massively interesting way to invest to generate alpha. There's the issue of, as a large long-term shareholder, to influence outcomes because you're long-term from a risk management perspective. But there's also, so one would have thought that given the success of generation, a few others, you'd be seeing a lot more of that, but you really are not. Why is that? Is that just because it's very hard to do? Is that because people don't realize it's possible, or what? Maybe we start with you, Chris.
Well, I was the first CIO to hire generation in the USA. And what I can tell you, we've had them for a long time. What I can tell you is they pick companies that are interestingly very good at S, very good at E, and actually typically very poor at G, because they're family-owned enterprises. And the key statistic, I think, between a generations portfolio and many of the companies that Hiro cited, they are companies that have been around for 100 years to 200 years. And so the CEO has a sense of intergenerational value chain to the corporation, a need to keep that company alive and think longer term. And I think when you really peel back the statistics, and as you said, it's simple. Are you better off with a CEO who thinks in 91-day periods, like is pushed on them in the USA, or somebody who actually thinks in 5, 10, and maybe even 50-year periods? So thinking longer term. Generation is darn expensive. They have outperformed their fees. They are one of my few managers that are truly global and have outperformed their fees over a long time period. So to them, it's really stock selection and it's deep dive into ESG. Most people who do it really give it a superficial look at E, S, and G and use simple metrics, not the hard on-the-ground analysis.
Yeah, that's my point. I mean, that's why I think that's part of what we're doing on the research front, and we talk about this quite a bit on campus, is that, you know, they only manage 25 billion. There are a few other managers like that that have generated outperformance. But the issue really is more people should be doing this. And if you do that, you'll find capital going to companies that are doing better. I mean, there's the other issue, by the way, of if you do that kind of analysis and see, look, activist investing in ESG is another issue, right? Which is if you find deficiencies in certain ESG characteristics which are material for a particular company and companies are not doing well, just like an activist investor would take a big block of stock in a company they felt were not doing well strategically, there is alpha to be generated by buying those companies on the cheap and then helping them drive the ESG performance. That's another big area that seems to be gathering some momentum.
I find that ESG issues typically are 5 years long, so they're very long-term oriented.
Yeah.
Hiro?
Well, I mean, I have I have a private equity background, and before GPIF, I was a part of the private equity fund. So all the big asset owner over the last 2 decades allocated more of their portfolio into private equity, believing they deliver excess return. And when I compare those two public and private investors, I mean, the private equity, they thrive on the lack of information. They thrive on the asymmetry of information, and they make a judgment, and they believe in some of the value drivers. And also they have the relatively longer term for their investment, the time horizon. So I think this is the time for the public equity investor have to think why the private equity continue to outperform public equities. And that's in my interpretation. My conclusion is public equity investors, active manager, have to have a courage to take those information or even a lack of information into their investment decision making. And this create the once in a lifetime, the alpha generating opportunities for them. And I agree with the Vikram. If the more active manager, started using the ESG information, well, maybe in some days alpha will be gone anyway. But this is the time that we need a more active manager to use it. And this is a great time for the active manager to kind of bet on the ESG factors, and that will drive the performance for them and for the beneficiaries, like including CalSTRS and the GPIF.
So one of the key themes which have kind of evolved here, which is this whole issue of the business roundtable, and what it's been for the audience here. The business roundtable is what it sounds like. It's a business roundtable of the leading businesses around the world, and for the first time, while they've talked about stakeholder things, they came out with a very directed statement last August of stakeholder focus rather than shareholder focus, and the metrics of that, or the components of that, were value to customers, employees, suppliers, communities, and shareholders. But then the question is, the first 4, if you do well, you need to do well to deliver shareholder value. So again, like, what's different this time would be a question to ask. And the question then is that what are the metrics being used? So for shareholders, we've got metrics, which is the share price in effect, or share returns over time, share price and dividends. but do we have metrics for these other 4? And are companies actually going to be managing for those 4 as an end in itself, or as a means to an end to a better share price? And that's the big question, because means to an end of better share price has been done for a long time. So I wanted to show you a Johnson & Johnson credo as part of the stakeholder kind of discussion. They lay out the responsibilities to a world at large in this order: patients, doctors, their customers, their business partners, their employees and communities, the environment, climate, and their shareholders should realize a fair risk-adjusted return. This is the Johnson & Johnson credo. When was this Johnson & Johnson credo put in place? 1942. And so this is not something that is new and earth-shattering, but it's something which, again, is like, you have these credos, but what have companies been doing about it, and what should they be doing about it going forward? So with that, let me just have a 2-page wrap here. So in the case for integrating ESG impact investing, I mean, I think it's come out in the discussion here that better investment decisions. We are focused on long-term value creation, and it gets away from what Chris was saying, the 90 days versus the long-term, the 5-year plus. In emerging markets and other places, there is a huge underserved customer base, and particularly for private equity investments, which are underserved and therefore a massive opportunity as the aspirational middle class goes up. If more and more evidence suggests that you don't have to sacrifice financial returns, you can live consistent with your values without it costing you anything. And something we haven't touched on today, but there's a whole other module as to how you use financial innovation to have more effective philanthropy and CSR. The concerns, which are clearly there, 20% of you felt that you had to have a trade-off when we did the poll. Friedman, the social responsive business is to increase profits. Anytime you reduce the investable kind of universe, you will reduce returns. Multitasking, managing to a financial return and a social return is very difficult. And typically when people have that trade-off, they gravitate towards the financial return. I think in the public markets now we are developing more and more track records of performance, which is becoming accepted. In the private markets, we're still a long way away from that. And then the last piece, which is work in process, is impact measurement and greenwashing. I mean, you're just talking about SEC coming up with naming funds because everyone is now trying to name themselves some sort of an ESG or sustainable fund to get more capital under management. Stepping back, the last piece here, which is, what is your personal goal as people on the audience here? From an investment portfolio perspective, your own portfolio, yes, you should be looking at risk and return, but do think about incorporating impact. It's become, as we've said, there's a discussion, it's critical. It's critical for long-term value creation. And then there's also the issue for your personal effectiveness and philanthropy giving. Again, we didn't touch on this right piece because of your focusing on public markets. So with that, I would like to thank our guests. You've been absolutely real troopers, one on vacation, the other one getting up at 6 a.m. So we really, really appreciate your thoughts and input here. Hiro, I look forward to seeing you on campus whenever we can see each other. And Chris, hopefully see you soon. And thank you all for being with us on this important topic, and have a wonderful evening. Thank you.
Thank you.